Hey, it's Mike Lynch with AmeriFirst Financial, and it's Monday morning, the week of February the 21st, and it's time for your Monday morning mortgage update. So we'll talk about what happened last week, what happened with your weekend, and then the three things that are going to affect the market. So let's talk about the weekend. Had a great weekend. I'm in Anderson Rotary, and we had our wild game feed, our annual wild game feed. It's the first time we've had it in 2 years since COVID started, and it was a great success. We raised thousands of dollars for charity, had a wonderful weekend, and thank you for everybody that showed up and donated. I think we served over 400 people some amazing food. All right, so what happened in the market last week and what's happening this week? So the market last week, we saw another sell-off, over 100 basis points sell-off in the bond market, which means mortgage rates went up again. It's the second week we've had this big of a sell-off in the bond market. Let's look at the charts to see how that really has impacted mortgage rates. So again, this is a mortgage-backed securities chart. I've showed this many times over the months. And mortgage interest rates are traded by the trading of mortgage-backed securities in the bond market. And if you go back to this chart, you can see I can hover here back just to March 30th of 2020. These levels here are the highest levels in mortgage-backed securities we've ever seen. And we know we all took advantage of those incredibly low interest rates. And basically, when money flows into that bond market, mortgage rates go down. So that's represented by the green up, right? So when you see a movement up in this graph, mortgage rates are getting better. On the other side of it, when money's flowing out of that bond market, that's the red. That means rates are getting worse. And so we had a great run. And then in October of last year, November of last year, the Fed said, we're going to stop buying mortgage-backed securities. We've talked about this. They've been buying billions of dollars in mortgage-backed securities since COVID started, and now they're going to stop. We knew it couldn't last forever. And so in October, they said, we're going to stop buying those in June. Well, inflation is rampant. It's the highest it's ever been. It's out of control. So in January, they said, sorry, we're going to stop buying those in March now. And you can see that we did see the market getting worse from October to January, but a really big acceleration from January to today. And the primary cause of that is because the Fed's getting out of the bond market. And a week and a half ago, they stopped. They're not buying mortgage-backed securities anymore, and mortgage rates are going up. That's one of the causes. The other cause is inflation. Inflation is the death of rates, and the higher inflation goes, we know we're at record levels, that's going to cause those mortgage rates to go up. So we really don't expect rates to go up or to get better anytime soon. Maybe we'll normalize moving forward, but we absolutely expect rates to get worse. On the market is another 56 point sell-off. This is a live chart just on a Monday. So very, very interesting, very concerning for rates. Now, this is where we as real estate professionals become the interpreter of the information, because there's a lot of misinformation out there. There's a lot of confusion. And when our clients get this information through media sources, a lot of it's incorrect. We have to be the interpreter of that information. We have to let them know, hey, rates are still really good historically. Home prices are probably going to continue to go up. And they may not go up at 20%. So we have to let them know really what's happening in that market. Well, let's talk about the three things that are going to affect the market this week. Really, it's the Fed, world issues, and oil. So the Fed, as we know, last week met and raised interest rates 0.25%. The Fed fund rate 0.25%. Now that's the Fed fund rate. So that's not mortgage rates, but it does have an indirect impact on mortgage rates. The Fed fund rate, they haven't raised that since 2018. They were going to raise it 0.5%, but because of the war with Russia and Ukraine, they kind of tapered it back a little bit and decided they didn't want to shock the economy. But what they did say is that we're probably going to raise it every single meeting for the rest of 2022, which is really 6 more rate hikes. Some people are proposing that they raise that rate 0.5% at the next meeting. So the bond market already factored that rate hike months ago into their pricing. So we didn't see a big impact from that Fed announcement last week. There was a lot of other things that caused the market to sell off because the bond traders have already anticipated this was going to happen. Long term, a Fed rate hike is actually good for the economy. And what I mean by that is the primary reason the Fed's raising this rate hike is to offset the impact of inflation. Inflation is horrible for interest rates. So as the Fed raises this rate, it's going to have long-term benefits on mortgage rates, and the bond traders know this. It's not going to have a short-term impact. It's going to have a long-term impact. And if inflation gets under control, these rates will start to normalize and come back down. So the other thing that we're all looking at as well, and this has to do with the Fed raising that rate, is a recession. And there's a lot of indicators that a recession is on the way, 12, 24 months. We don't know when it's going to happen, but it is coming. We historically always have a recession. And so, you know, let's be honest. We all have a little bit of PTSD from the last recession. Housing prices dropped 40, 50%. And that was a very unique recession because it was a recession caused by the housing bubble. This chart I'm showing you is a comparison or an overlay with the Case-Shiller U.S. National Home Price Index, which is the gold standard to analyze and determine prices of homes that are sold nationally, and recession. So if you look at the blue line, this indicates the housing prices since the 1960s. And if you look at the gray bars here, this is when we had a recession. And if you look at this, housing prices have actually done fairly well in a recession, except for one. And that was the recession we had in 2008, 2009, which was caused primarily by the housing bubble. All other recessions were caused by economic issues outside of the housing bubble. And again, if you look at the blue line, it gives you a really strong indication that we've had strong performances in the housing market during these recessions. The other thing you think about is during a recession, rates actually get better, typically. And so one of the ways that the Fed offsets a recession is to lower the Fed rate. So it's at 0.25% higher. It was at 0. So they're going to raise this 6 times this year. And when a recession hits, and it's going to come because it always does, the primary way the Fed offsets that is to lower the Fed fund rate. So they have to raise it so they can lower it. Interesting perspective. So let's look at the second thing that's going to affect the market, and that really is world issues. 2, the invasion of Ukraine by Russia continuing to cause economic issues, and they've talked about coming to the table and talking, but they keep bombing Ukraine. So there's a lot of mixed information out there. But the bottom line is having major world economic issues. We're seeing what's happening with oil prices as a primary cause of that. And then the second thing on world issues that's going to affect rates this week is COVID. Believe it or not, it hasn't gone away. And there's this new Omicron B.2 variant that is impacting China. China's shutting down ports, and we talked about this last week, and they're shutting down provinces. Now, when China shuts down a province, some of the provinces are over 1 million plus people, and they did shut down a major province. It's like the Silicon Valley of China. They shut that down last week, and that's going to continue to have supply issues. We've been dealing with this for a long time, but any supply issues means that we don't get what we need as far as products, and that impacts our economy. So the third and final thing is oil. Now, we know oil prices are at the highest they've ever been. This is a chart. You can pull this up anywhere online that shows oil prices way back in September of last year and oil prices, in the last few days. And we can see the big spike in oil prices since December of last year. We've seen those oil prices continue to go up. Primary cause of this is the unrest with Ukraine and Russia. So if oil prices start to normalize or come down, and we saw this happen really since the beginning of March to the middle of March, and then they went up last week. But if these oil prices, if the dollar of a barrel, which is at 112 this morning, if it can get down below $80 a barrel, that's actually good for mortgage rates. Now, 2 things can cause this. It's not rocket science, it's supply and demand. If we have more supply, which means countries are starting to produce and export more oil, which a lot of countries are on board with this. If we as the United States open up some of our supplies or our ability to produce oil domestically, that's going to impact supply. That'll lower prices. Demand. If we have a slower economy, people are going to travel less, maybe not go on as many vacations, use less oil. That's going to have an impact on oil prices. But look, the last time we had oil prices at $80 a barrel, you can see here, was the beginning of January. So we got a long way to go, but it is possible. If we start to see a little bit of a sell-off on those oil prices moving forward, again, that could have an impact on mortgage rates. So what's our take this week? Lock. I haven't been in an unlocking position for a long time. If somebody wants to play the market, they've lost money. We have advised all of our clients to lock. If you're in contract, if you have a close of escrow date, lock that loan, lock it a little bit longer. Don't play the market unless you're monitoring this on a hourly basis, which most people aren't. You're not going to win. So that's our position this week. Continue to lock. If you have any questions on the market, please let me know. If you have anybody that needs advice on locking, go ahead and shoot me an email and let me know. Share this with somebody that you think may benefit from this video. Have a wonderful, productive week, and we'll talk to you next week. Bye-bye.